Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch where each week Ben and I bring you the insider's guide to property investing. Hello, mate.
G'day, mate. How are you?
Good.
How are those push-ups going?
Oh,
I was driving in today and I thought I've got to ask how are those push-ups going.
well, I'll tell you how the push-ups are going.
Yeah.
I have not missed a day since the 1st of January this year.
Oh, terrific.
And I could see the look on your face because you were actually trying to catch me out.
No, I wasn't. So have you tallied up how many you've done?
No, because some
do you
days
do any extras? Little couple of bonus every now and then. You're feeling good. Just like push out 7 or 8.
In summer, I must admit, I've pushed sometimes 20s and 30s.
Yep.
In winter,
Ooh.
I'm getting the 10 done as quickly as I can because remember I'm doing it before I jump in the shower and it is freezing and I don't want to turn the heater on. I don't want to make any noise in the house because the kids stay asleep. So it's just bang out the push-ups and jump in the shower. So thank you for asking.
That's all right, because you know what?
I've
started my own. Okay. Do you want to know what it is?
Actually, I do.
Because I've got a bad back, right? So when I roll out of bed, it's a bit stiff. So I do 5 squats. So I just do 5 squats a day now.
Fair dinkum.
Just 5 squats, just to sort of get the body moving.
Can you hear all of our our
and
gym,
then the knees going.
Can you hear all of our gym going listeners going? You guys, are you serious? That's not even commitment. 10 and 5. In fact, we might even pass that on to our special guest today because I'm sure he does. A few more than
Well, I
10
think he's just come from the gym.
He probably has. But we do have a special guest today, folks. But before we get there, Ben.
Yes.
Mindset minute.
Mindset minute.
If you're working on something that you really care about, you don't have to be pushed. The vision pulls you. Steve Jobs.
It's true.
And that was Matt Skeen in our office. He threw that one to me.
Oh, yeah.
And I think it's a reflection of him because he's a bit like this. But if you work on something that you really care about, you don't have to be pushed. The vision pulls you. And of course, I've used that as a segue into our very special guest today, because it'd be fair to say the vision has pulled him since 2009. Welcome, Jeremy.
Thanks for having me.
We have it finally.
We've got
him. We've got him.
We've teased for a few weeks now, but Jeremy Sheppard is all things research, Ben. Loves the data and has a real vision that's pulling him towards finding the nirvana around capital growth. What drives property performance? And it's fair to say that he just devotes himself into the data. Is that right, mate?
Yeah, well, I do sleep at times. I eat.
When does that happen?
But as soon as I wake up, I'm back into the data. I'm thinking, how do I predict capital growth better?
Yeah. Now, before we go into that, what do you think about the 5 squats and the 10 push-ups for something? Is that a regime?
I think
that you
I could
might
do 20 push-ups in one breath.
Okay.
The world. There we go. Let's put
there we
it
go,
out there.
folks. Just belittling my little 1st of January to present day effort.
That's it. I'm giving up on me 5
But
squats.
I am having knee pain doing squats, so you'll probably beat me with 5 simple squats.
For those of you that one day get to meet Jeremy, he loves the gym. He's actually wouldn't be out of place on an AFL football field. He's in very fine form, aren't you, mate?
Oh, I try.
You try. But let's get back to something that's more interesting to our listeners.
Yes, exactly.
Supply. Well, Ben started with a heckle, so.
I wasn't a heckle. I was genuinely.
What did you think my answer was going to be?
Of course you would do it. How's the guitar going?
Oh, see, there it is. There it is. Folks, I don't even think that warrants an answer. But, mate, you have been very, very passionate about what makes for supply and demand and what drives property prices. But before we actually delve into that, tell us a little bit, how did you get involved in that in the first place? Because your background is in IT. How did you go from IT to looking at the numbers when it comes to property?
Yeah, well, I guess it's just having that slant towards numbers in general. I would look at the back of the property magazines and they'd publish a few stats there, and I thought, if this was the only data that I had available, which market out of these hundreds would I pick? And I started looking at the stats and trying to figure out, well, how do I interpret vacancy rate? What does it really mean? And I'd already been investing for quite some time. I started in 2002, so I'd been at it for I think 7 years. I had about 16 properties at that stage, and some were winners, some were losers, and I'm trying to figure out, well, what is it that really drives growth? And yeah, the concept of supply and demand is always spoken about. You hear just about every expert mention it all comes down to supply and demand. And it's so true. It's for everything. Real estate's no different. But how do we actually score it? When I'm looking for a market, what is it I'm actually looking for? And I guess I was just pondering over those indicators and thinking, well, I don't like this one because it doesn't really mean anything to me. This one is a great indicator of demand. This one's a great indicator of supply. What if I grabbed them all and put them together in some sort of algorithm and scored each property market? And that's where the demand to supply ratio came from.
What did that look like in the early days? Because obviously you're now a significant number of years down the track with with history and experience. But what was it like scrambling, trying to scramble all that data at the beginning to make sense of it?
Yeah, well, I guess just on paper, I would look at one market and think, well, what information is available, and I was trying to think, trying to picture a circumstance. So trying to picture an auction where you've got a huge number of bidders, and let's say all auctions in this area are very similar. So what are we looking at? We're looking at a high auction clearance rate. And I'd look at each individual statistic, and they were published by various different sources. So I thought, the first problem to solve is gathering it all together, and that's the big issue. And I didn't want to miss out on the best market in the country. So how am I going to get all this data for all markets and consistently, in a consistent manner, look at all of them the same way? So I guess how it looked was a bit of a mess to begin with.
15,000 plus suburbs. That's a lot of time.
Well, it's double that by units and houses as well. So
yeah, that's right.
It's a sizable database. Yeah.
Yeah, it was really. I guess on paper it looked fairly simple, but then trying to gather all the data together, that was where the big headache was. So yeah, you have to write programs, of course, which suited me because I was in IT.
What chance does the average punter have of working this out? If they, you were in IT, you're comfortable with programming. What about the poor old investor? What chance do they have?
Okay, yeah, I guess it's very difficult for them. But even other people in IT who have the skills to do something like that, you've still got to be able to interpret the data correctly. And I think it was just spending years pondering over what this statistic actually means and then how to bring it all together, because some stats are meaningless, others are more important, and then there are absolutely crucial ones. So you can't just be in IT, you can't just be in data, you've got to know property investing. So I was in that unique position where I was in IT and I'd been investing for quite a few years, and I just used to obsess about the data.
We should tell our listeners that's one of the reasons that we invited Jeremy to come and join us in our business, because of his strong research pedigree, and we found that that's been enormously beneficial to us. But Jeremy, I opened it with if you're working on something that you really care about, you don't have to be pushed, the vision pulls you. What was the ideal nirvana for you when you were trying to create this research solution?
Well, honestly, I think I sort of stumbled upon it. Like, I was just looking at the statistics, trying to figure out how I can analyse them better and make it simple for myself. And I guess it was, I wasn't afraid of investing in areas I didn't know, so long as the data backed it up. And that meant that I wanted data from around the country. So I just didn't want to miss out on, say, an opportunity that's in Perth or in Sydney or Brisbane or Hobart. I didn't care where it was. I wanted the best location. So for me, it wasn't so much a vision as apart from just wanting a better handle on property investing, knowing why locations grow and other locations don't.
Best bang for your buck, basically, wasn't it?
Yeah,
That's what you're looking for. You're trying to make your dollar earn a better return. You're taking out the emotion.
I want to get the best spot.
Yeah, you don't care that it's bricks and mortar bank account. I mean, that's what it is, a bricks and mortar. You don't care about the property per se. You care about the return that it's going to deliver.
And there's a fair bit at stake with this too, because if you buy a property that for $500,000 and track its progress after 20 years, the difference between a 5%, a 7%, and a 9% is actually quite enormous in terms of real terms. So, the challenge for property investors, and we see it all the time in the business here, is they they don't realise the implications of their decision until down the track, which makes sense. They're looking in a rear vision mirror. But the challenging thing is they can't get that time back. And so as we go through this accumulation phase, they've got a finite amount of time. And if they're lucky, they started really early. But for a lot of people, they're starting sort of at best in the middle, or maybe not at best, but on average in the middle of their working career and some towards the end. So if they get that decision wrong early days, it doesn't manifest itself until later down the track. It's kind of a sleeping sort of
realisation.
Derailer, isn't it? So,
I mean,
so there's a fair bit at stake.
Yeah, I noticed with my own portfolio, I mentioned before there are some winners and losers, and it was a journey of discovery, realising just how important capital growth is. And it really is the ants pants of property investing. You can add a little bit of value by doing your renos and subdivisions and so on. But honestly, the difference I got in my portfolio from good capital growth was just staggering. And I knock up a spreadsheet every time I'm going to buy a property. And, I love the numbers. And I'm just trying to figure out how much is this going to earn me long term. And that capital growth figure, that estimate that I put in, is just so crucial to the performance of the portfolio I had to focus more and more on capital growth. And the great thing about it is, it's not as hard as people think. Most people are thinking that the capital growth is speculating. So let's focus on a reno. Let's make equity happen. But if you don't understand renos, you're wasting your time. And if the only thing you understand about renos is how to make money, then you've got to sell every time. It's got to be a flip. Why are you holding it if you don't know about the capital growth?
Because you did a reno, didn't you? You did.
I did tons.
And winners and losers in that space as well.
Yeah, I can remember spending $40,000 on one reno and increased. The new value was $41,000.
Yeah.
So
can't
total
go broke
waste
making
of
a profit.
True. So I mean, obviously, let's get the listeners into what are the variables that we've introduced. Supply and demand. So what we want to do is obviously, this is also about helping DIYers. So we want to talk about some of these variables and work through them, but also sort of give some tips of where to find that information and how you might go about it yourself to give them a good insight into what they look like. So let's start with stock on market. Obviously, this is all about measuring supply and demand. So let's talk to stock on market. Jez?
Okay, so the stock on market is obviously, as you say, an indicator of supply. Supply and demand are really the only two things that are going to determine the future price of any product or service. Real estate, no different to that. So we want to know what markets have oversupply or undersupply, and the stock on market is a great indicator of that. But you've got to be careful that you don't just look at a single figure here. So you could have a massive market which has only 10 properties on the market, and as a percentage it might only be 0.1%. Then you could have only 2 properties on the market, but if it's a small market, that could represent 2%. So really what we're after is the percentage of stock on market. So
I'll give you an example. Yeah. So Bundoora is a big suburb in the northern area where I grew up in Melbourne. And I think there's about 16,000 suburbs there. So
suburbs or houses?
Houses. So having
that's a big area.
100 properties for sale could represent obviously a small percentage.
That's right,
as opposed to you go into a small town, a regional town, and the whole town might have 80 properties in it. And there's 2 properties for sale.
Yeah, the key point there is it's the percentage of stock on market. So you need to know how many properties are currently for sale, which is easy to do. You just look up on realestate.com.au or domain.com.au. But then you need to calculate that as a percentage of the total properties in the area. And that gives you your percentage stock on market.
So is there a quick reference for the listeners, or is that a bit harder than it sounds? So they can go to the portals and get the for sale, but how do they quickly find out how many properties are in a suburb?
Well, might not be quick, but the Australian Bureau of Statistics publishes data about that. You could also get some data of that nature from CoreLogic, but it might not be quick and might not be free.
And any benchmarks that you look for in terms of where your indicators are comfortable?
Yeah, so around about 1% or lower. Mm-hmm. Anything higher than that is a little bit high.
Okay.
So there you have it. You can obviously go out there, do it yourself by going and checking out those websites, getting that information and start to build that spreadsheet and then start tracking that. Because what you're also tracking is, that's a gate, past that gate 1% or lower, and then sort of monitoring that over time. Because as some areas get new stock coming online, and that's obviously going to change the volume, and it's going to also potentially change the percentage. And as the economy moves and jobs move, that stock on market is also, like Perth is a good example, Darwin is a good example of that, where that percentage would be fluctuating at the moment into the negative.
And have you got any tips for the listeners on how long they should be tracking that before they sort of look to put their money in the market? Should there be a minimum?
Well, the first thing I want to point out is that you shouldn't base your investing decisions on a single statistic. I mean, there can be anomalies with it. For example, let's say you've got a unit complex and the developer has 50 units for sale, but some of them are 1 bedroom, some of them are 2 bedroom, and some are 3 bedroom. So they'll list an example 1, 2, and 3. So if you're looking online, you may think there's only 3 properties for sale when actually there's 50. So there can be anomalies in the data, and it can fluctuate from month to month. So it's good to look at an historical chart and just see how it's bouncing about, and your eye will calculate its own line of best fit, and then you've got a good rough idea of what the market's like.
All right, so stock and market's the first one. What's the second one you look at?
Auction clearance rate. Ben, do you want to take us away?
Yeah, sure. I mean, obviously this is one that I love because it's giving me a fairly quick indication of activity in a particular market. So in terms of what I'm looking at here is I get a direct read within days, the Sunday papers. By Monday, I've got sort of most of the search engine portals who are bringing me some indications of what the results have been over the weekend. So it really is a terrific indicator for the level of demand in a particular suburb, subject to the major proportion of properties being sold by that process. It's really important to understand that when you go into certain markets, maybe Adelaide, Brisbane are classic examples where the proportion of properties aren't being sold through that sales mechanism. It's really interesting to understand that. So to do that though, and this is another classic case of you can't just use that one variable to be able to go and analyse that. So again, what do? You go into the search engine portals, you pick the paper up on the Sunday and you collate all that information and you start to monitor that. So, you can be caught out on a couple of things here. If there's only been one auction and it's sold, that's 100%. So you can also, again, you want to be looking at some of that trend because, you're sort of thinking there might be another suburb where there was 16 properties that went for auction and 15 of those 16 sold. Well, that is a very good indication that there's a lot of interest and buyer activity in that. Whereas that 1-to-1, it could just be, a beautiful property that the agent said, yes, you must sell this by auction, even though everything around here goes by private treaty, and it gets the result because it's got that owner-occupier appeal and that status appeal and all that other stuff.
You want context of norm as well. If there's been typically, 900 auctions, 950 auctions, and then all of a sudden it goes down to 400, and it might have been a public holiday, long weekend. Because for us, with our team of the buyers agents, we use that as a really strong metric for us, not only from the clearance rate for, they announce it for Melbourne or Sydney, but in the investment grade suburbs that we identify, we want to know what the clearance rate is for those particular suburbs. And equally with some of the agents, what was their clearance rate for the auctions that they have? Because you can get patterns. Some of the better agents get the better properties and all those sorts of things. So auction
by property
rate,
type, by number of bedrooms, because you do get that great insight into the actual data because you're getting the property itself, and so you're able to get the attributes of each of that property. So it's quite interesting. In some cases, we're also collecting data on whether they're brick and weatherboard and land size and all those other things to try and get an interpretation at that granular level. But coming back to the location area, it's obviously a terrific one. Did you want to add anything more to that?
Oh, just that trying to keep things in perspective here, we're looking for markets where demand exceeds supply. And I think just about everyone can identify with the case. You rock up to an auction, there's 20 people there, you've got 6 genuine bidders, it's quite fierce. There is a clear indication there that demand exceeds supply, and that property is going to sell. And so the auction clearance rate is a good indicator of demand exceeding supply.
All right, so what's the next indicator you look for, Jeremy?
Well, let's talk about online search interest. So this is the websites keep track of who visits them. They've got a listing of a property for sale, and they may have 20 people visit that property in terms of the page online, maybe not actually turning up, but they visit the property online, and that there's a record that's kept of that. So if they can compare the number of visits they get by people online with the total number of properties that are for sale, then you've got a little demand to supply ratio right there in that one indicator. So you may have 20 people looking per property. That might be quite a high search number. So the online search interest is a calculation that considers the total number of people visiting versus the total number of properties available.
And does that take into it? So it probably gets skewed a little bit when I'm looking at the big sort of 20-acre sprawling estate in Toorak, right. Or as my wife would like us to go to the Byron Bay hinterland with that view down to the lighthouse. So some of those anomalies exist maybe on the top end or aspirational, but in the general bell curve, that'd be a good indicator.
Yeah, well, I mean, you could just have the vendor looking up their own property. What's it like? Or people that are curious. And then there's complications with actually measuring a unique visitor. If someone isn't actually logged in, they're just looking at an IP address where the request for that page came from. And of course, with Wi-Fi hotspots all around the country, you could have the same individual looking at the same property online a number of times. So yeah, there are always anomalies with just about every statistic. And so, of course, you want to look at a large range of statistics and not focus on just one.
And it does make mention to the way in which you effectively collate your data. So if you can get more sources of a particular data set, you will then obviously look at that and then sort of get a mean or an average for those.
That's
as
right.
you put it through the algorithm.
Yeah, there are a couple of different ways in which you can calculate your own online search interest. So there are a number of different data providers for auction results and for stock on market. So you just need to look at a broad range of them, and some might have anomalies one week and not the next. So you're trying, like you said, to get the mean, the average of them.
That's what makes it so hard, isn't it, just for the individual person? Because even auction clearance rate, if we talk about the previous one, Domain calculates it different to realestate.com, which calculates it different.
And not everyone's grabbing the same data. So the more data sets you can get your hands on, the
more
your data
accurate
set.
it's going to be.
So is there any tips for the listeners on how they get that online search interest? That's straight on the listing. There's a pull out that they can find.
Yeah, actually the investor section on realestate.com.au has a calculation of the number of people that they are estimating are visiting a property per property online.
Mm-hmm.
So good. That's terrific. Good insights. What else have we got?
All right, next one. This one I think is really important, days on market. So the days on market is a calculation of a property gets listed for sale, it eventually becomes delisted once it does sell, and that period of time is the days on market. Now, if you calculate the average days on market for each property in, say, a suburb, then you've got a good indicator of supply and demand, because you know what it's like in a high demand versus supply area. Properties get snapped up really quickly all the time. People are continually being pipped to the post, and they know they need to make good, strong offers and very quickly. And so in oversupplied markets, of course, you can take your time. Vendors are very negotiable, of course, and you get the opposite effect. So the days on market is a very good indicator of supply and demand.
It makes sense, doesn't it? When you think about it, if a property's lasting 10 days on the site and it's gone, it's like, oh, that was interesting. So you got to pick the trend, because again, it could be a one-off beautiful property that everyone says, if that property ever comes up for sale, I want to buy it, as opposed to, well, there's a trend we're seeing here, and that's why it's so great. You're not just looking at one property in isolation. For me, that makes perfect sense. The other thing we also should highlight here is again coming back to that one variable and making decisions just on one variable. What a classic case would be is that if you're doing an auction campaign, most auction campaigns will last between sort of 4 and 6 weeks, roughly 4 and 6 weeks. So is there a number that you say that you're looking for in terms of days that you would say is, anything below that is really healthy, anything above that is probably getting to a stage where you're going to score it lower?
Yeah, well, I think somewhere around the 3-month mark is around the benchmark that I would look at.
Because that's got private treaty, that's got all of those other aspects in it. Yeah.
But of course, you can't, like you mentioned, if you look at a single property, you could get a wildly different figure for the one that sells next door the following week.
Yep.
So you've really got to look at a large number of properties for the entire suburb that you're researching.
Yeah, you need context, don't you?
Yeah.
You need context to the norm.
And that's the context of it. So go back to that auction. Like if the majority, like let's say 80% of the properties in that area sell by auction, and most agents are saying, we've got a lot of interest in this property, we're going to auction, then obviously it's not going to sell pre-auction. So those 24 days or those 30 days are set. And even though they could have sold it 3 times over on day 10, it's still in there. So that's again about sort of, munging the data, as you keep telling me, Jeremy, about putting all of that stuff together to effectively get that overall score.
Where it helps a lot is, we've talked about, Ben, many times, the growth asset, the balanced asset and the yield asset. And a lot of growth assets in the big metropolises go for auction. But if you're thinking about your balanced assets and your yielding assets, they're quite often private sale, which means this metric becomes really
picks
relevant.
them up really well, which is good. Fantastic.
All right, mate.
Vacancy rate. Vacancy rate. I also think this one's really important, vacancy rate. It's a great precursor of good cash flow. So what happens is you get a location that, for whatever reason, is of high appeal to tenants. Tenants are a lot more agile than owners because it's so easy to get a lease, a lot harder to get a mortgage. So if as soon as a market becomes attractive, you find the first people to flow there are the tenants. And they soak up all the available landlord-owned stock, and the vacancy rate comes down to 0 or very close to it. That is a great indicator that in the future you're going to see yields rise. Obviously, you might have, say, a 12-month lease. You've got to wait for that to finish before you can lift the rent up. And your property manager might say, oh, look, there's tremendous demand for rental properties. So we could probably ask for another $20 a week or something along those lines. But it stems from vacancy rates. It's a very early indicator of the potential for yields to go up. And of course, once yields go up, you get more investors moving into the market. And whatever it was that was appealing to tenants, well, tenants are humans too. So owner-occupiers find the place just as attractive and they will eventually move in as well. So it's a very early indicator of the potential for demand to exceed supply, and very important statistic in terms of maintaining good cash flow. Yeah,
because as the vacancy squeeze, more investors are interested, which will bring more people to it.
Yeah, that's a classic one. We know that there are investors out there who want to invest on cash flow and so forth. So, if the market is 70-30, 70% owner-occupied, 30% investor, but if all roads lead to a really good yielding area that's part of a metropolis or whatever, that is that additional stimulus, because what we're looking for here is an imbalance in the supply and demand. So, we know of many locations where there's lots of investors going into those locations. So the data that we're scoring is basically seeing that happen, because the data doesn't care whether it's owner, occupier or investor, does it? It just cares on who's interested in buying there to push that score higher.
Yeah, it's one of the 4 things. When I'm looking at a property, I'm sort of mentally running through, okay, what's its capital growth performance? Because I want to know what the precedent's been. That's 1. 2, I want to know what the yield is, and that's pretty easy to work out. 3, I want to know what the vacancy rate is, because those first 2 might be right, but the vacancy rate might be going the wrong way. And then the 4th one for me is what's the quality of the tenant. And I always use this example where it's stacked up for, there was a property I was looking at in inner west of Melbourne. It was in Footscray. I stood out the front. Capital growth historically been great. Rental yield was looking pretty good. Vacancy rate was really low. And then I got to the quality of tenant, and I thought that it was just about to change, because there was a huge student accommodation complex that was being built next to it. Massive, big car park across the road. So I actually think going forward, the quality of the tenant was about to change, because if you've just got student parties, all of a sudden the quality of the tenant who would have been in that property prior, a different one going forward might have been might have changed. So despite the fact the first 3 stacked up the quality of tenant, so it's definitely one of the 4 filters that I run through as I'm looking at a property for a client.
Can I just explain to listeners just here's how you calculate your own vacancy rate?
Yeah, good idea.
So what you've got to do obviously is jump on realestate.com.au or domain.com.au and you look for properties for rent, and you get a count of those. Then all you need to know is how many of the properties in the area are owned by landlords as opposed to owner-occupiers. So there may be 1,000 properties in the area, but only 100 are owned by landlords. And then if 10 of those are for rent, then you've got quite a high vacancy rate. So you've got to grab some data from the ABS, which has the breakdown of owner-occupiers to renters, which we'll talk about soon, and then you can calculate your vacancy rate. And the good thing about vacancy rate is you can grab a snapshot right now. You can jump online and get a number of properties that are currently for rent. And
you do that by just basically punching in the suburb and hit search.
Yeah.
Don't you? You know, well, obviously for rent. So you're in
For
the rent. You're in the rent section. You put a suburb in, and there'll be a number. It'll say 1 of 200, 1 of 20, 1 of 65,
That's right,
or whatever
yeah.
it might be.
Just you want to be careful you don't include surrounding suburbs though.
Yes.
So yeah,
Click,
you're just targeting.
unclick that button.
Yeah. It's usually there clicked by default.
Yes, it is.
And how's that that calculation? I know the answer for the listeners. The different from what's the vacancy rate that's published by REIP, REIQ.
Yeah, they all vary dramatically, and it comes down to a number of things. Some of the listings might have an available